Hi, everyone. Hope everyone out there is keeping well, staying healthy and safe. Welcome to the discussion this afternoon. My name is Jensen Clark. I'll be your moderator. We are here to discuss public-private partnerships and how they could benefit the U.S. healthcare system, and to discuss some of the challenges the model faces for adoption. We've got 45 minutes. I'd love this to be a free-flowing discussion, more of a fireside chat. So please, if you have any questions you'd like to ask, please send them in and I'll work them into to today's schedule. Before I introduce our esteemed panelists, just wanted to give you a bit of background on Fengate, my firm. Fengate is a developer and investor of P3 projects in both Canada and the United States. We have about 30 in our portfolio. Almost half of them are healthcare projects and all are operational. These range from full acute care to outpatient, mental health, to long-term care. So really the full spectrum. And I've had the pleasure to work with a lot of P3 participants in developing these projects over the years. So without further ado, I'll, in the true essence of P3, I'll let our panelists introduce themselves. We'll start at the DB, then we'll go to the FM, and then lastly, we'll introduce the sureties. So Darren?
Thanks, Jensen. My name is Darren Early. I'm a managing director and head of public-private partnerships with Gilbane Development. Gilbane Inc. is one of the largest builders and developers of social infrastructure in the country here in the U.S., in addition to being a top 3 builder of healthcare facilities. Across our portfolio, we have about $1.5 billion worth of public-private partnership investments, and we have built and or developed everything from regional care facilities to institutional hospital settings to acute care facilities. I'll turn it over to my colleague, Claudio from JCI.
Thanks, Darren. So it's Claudio Andretta. I head up business development for our alternate delivery group, known as the Public-Private Partnership Group, but in healthcare in the U.S., that doesn't mean much, but certainly alternate delivery. So we've got a team dedicated to doing these types of projects. We've been successful on 40 of them, half of which are in the healthcare space. Again, much like with Fengate, many of those are up in Canada. But, we can certainly talk about the application for the U.S. healthcare model, and we'll get deeper into that. But Johnson Controls ends up being the operator on these particular projects. You'll know Johnson from probably a lot of our facility systems that we install in hospitals and central plants across healthcare. But yeah, in the case of this alternate delivery, we are also the long-term operator, and we'll talk a little bit about more what that role is. But thanks. Over to you, Rosemary.
Okay, thank you. Hi, I'm Rosemary Quinn. I'm General Counsel, and I lead the non-claim legal operations for CNA Surety. We're one of the largest providers of surety bonds in the United States. We also are a provider of surety bonds in Canada. In the United States, we have been a supporter of providing surety bonds, which acts as a performance security on construction projects of all varieties of delivery systems, including P3s, or design, build, finance. We've also have provided that same type of support and security for projects up in Canada, where we have an office in Toronto. And in Canada, we have been active and participating in providing such performance security for various healthcare-related projects. In the United States, we've certainly provided surety bonds on healthcare projects, but we have not participated on any P3 healthcare project here in the States. But we're very active and are very familiar with the Canadian marketplace there. Thank you.
Yeah, thank you, Rosemary. And it's really great to have everybody here. We really do have expertise from the construction, maintenance, and surety and development community. So we kind of have all the the major players represented here. Before we get into our discussion today, I want to just give a quick refresher on the basics of P3. So I have this slide up here, and if you can't, I apologize for the smaller font. I realize not everybody will be able to read it, but effectively, a P3, or why don't we get away from the term P3? Firstly, Claudio mentioned alternative delivery. I think we should be using the word performance-based infrastructure. So what is this at its core? It starts off with an entity. It could be a government entity at a municipality, a state or provincial level, or federal level, or it could be a corporation, a creditworthy corporation with a large balance sheet. And that entity is looking to transfer risk and procure a piece of infrastructure for typically a longer period of time. So what happens in most cases is the design, build, financial and maintenance risks are passed down to someone, to an entity, typically to a special purpose vehicle or corporate entity set up specifically to deal with the project. This is funded by a combination of debt and equity. Equity, a lot of times from folks like myself. And then once this entity retains all of these risks are then passed to industrial partners who are best able to manage them. Construction partners like Gilbane, for instance, or maintenance partners like Johnson Controls to carry out these works. One of the key elements here, in order for this model to be held together, the glue, if you will, are a lot of the guarantees or surety products that Rosemary would be responsible for, issued by these industrial companies to secure this performance, to secure fixed price obligations on the construction side and on the maintenance side. So effectively, what's happened is this consortium that you see in front of us has typically bid a fixed price to encapsulate all of the obligations I've just mentioned, and is bidding effectively a rent payment to repay the capital, finance the construction, and also to pay for maintenance, life cycle works, and in a lot of cases, an energy sort of guarantee. To the nature of being performance based, if this entity or consortium does not perform, then a portion of that rent is held back, and it is typically held back from the entity that didn't do their job properly, frankly. So that's the beauty of performance-based contracting, and that risk is taken completely away from the government entity or the issuing corporation. And just before we leave our 101, I'll just put up a quick risk transfer slide, and we can kind of get back to this. But what you'll see up is a matrix of risks. You'll see the sponsor in green, which basically assumes the risks for things that are unforeseen, force majeure events, interactions with external utilities, changes in law, things of that nature. But the rest of those risks are borne by the concessionaire and ultimately with the folks in attendance here. So with that kind of brief 101 out of the way, I'd like to move on to the broader discussion, and I'd like to kind of get into the topic of the healthcare sector in Canada and other jurisdictions has adopted this performance-based model. But I'd like to talk a bit now about why perhaps this is more challenging in the U.S. and maybe some of the ways that we could spur this model. Darren, why don't I start with you? Maybe we could talk a bit about your views and how the construction development side could leverage this performance-based model.
Sure, thanks, Jensen. Well, to address your first point about why has there been a disparity of this performance-based model implemented in Canada versus here in the U.S., I believe it's fundamentally attributed to how both healthcare systems are modeled, where you have a public-based, social-based healthcare system up in Canada. You have a more private-based system here, whether that's through private ownership or through a not-for-profit ownership. So by virtue of that model, I think you have the difference. Now, there is an inherent benefit to utilizing a performance-based infrastructure model. And that benefit you touched on, particularly from a design build standpoint. It's taking the risk of execution for these projects and it's transferring the management and the execution of that to an entity, frankly, that does that day in and day out. So where you would have a conventional approach being where perhaps a facilities group or a capital programs group or maybe even a CFO's office would be running and managing from an ownership perspective the execution of building a new facility, designing a new facility, operating a new facility, using this performance-based model. That's obviously transferred over to a group like ours through that project company that you noted. And then ultimately, from an operations standpoint, if that is part of the desire of the healthcare system, over an extended period of time, seeing that transferred to a firm like JCI and Claudio's. So that's what I see sort of as the fundamental difference and really the core of what the benefit could be considering what is an alternative delivery model in the healthcare space.
Anyone else? Claudio, any thoughts?
Yeah, I'll give you some thoughts. We've had numerous discussions with healthcare organizations in the U.S. about performance-based infrastructure, Jensen. And I think part of the barrier is just decision-making in private entities, as Darren's mentioned. I mean, decisions for 30-year contracts is not something that you see a lot of private entities engaging into. So I think there's got to be a willingness for healthcare to embrace that. But I think on our side, on the project delivery side, there's got to be a bit more flexibility in maybe some of our contract terms to think that you're going to do these types of contracts the way that they're done in Canada, bringing that model to the US might be a little bit problematic. So I think we have to find a way of building in a little bit more flexibility without losing the guarantees and the risk transfer that these contracts offer up. I think is something that we need to think about. I think, quite frankly, one of the reasons why P3s have been more adopted in other jurisdictions is because they've done a value for money assessment, comparing the different delivery types, comparing design bid build versus design build versus, DBFOM or DBFM. And in a lot of cases, I mean, the projects that have moved forward as P3s or alternate delivery have done so because they found the value for money has created a lot more net present value benefit under a longer term DBFM delivery model. And so I think if there was more of that contract vehicle analysis on major healthcare projects or major renovation projects, I would venture to say that we'd see more DBFM type projects being done.
And I'll just speak from the surety's perspective. We are, at least I can only speak for my own company. We tend to be a bit blind to whether or not what is the delivery system that's being used for a particular project. Because as pointed out before by Darren, it's these contractors that are actually performing the work. They have their contractual obligations to build, construct, perhaps maintain for a period of time. That is what surety companies do day in and day out for all sorts of delivery systems on various projects. And that is where we come into play. And that doesn't change whether it's one of these alternative systems or a more traditional design build project. It's not going to be different because typically the surety does not have an expectation of taking any financial risk at that's at the concessionaire, that other level. We're looking to that contractor who's actually building. Can they do this? And are we confident in the payment stream and that they will be paid? And that's fair pricing, and can they do the work and things of that? So it really doesn't make a lot of difference. Certainly we don't want to, it's not a surety's place, and I can't speak for all, but for most of us, we're not here to pick up that financing risk per se. That is something for other parties on this call to be assuming. And but the work itself is, that's, we often say that we're almost like the easiest piece of this puzzle.
Yeah, I get that all the time as being the easiest piece in the puzzle. I'm surprised you do too. But no, those are all great points. And Claudio, especially on the value for money point, I mean, I think something I would use the word plaguing the U.S. is getting hung up on the cost of financing. We're seeing long-term debt for P3s, south of 3.5%. So this whole argument of, look, yes, it is going to be a little more expensive on the financing, but if you actually take the quantified benefit of a cost overrun in construction or operation, and you transfer that risk, it's not even close to the difference in the cost of financing. So I think that argument is there. In healthcare specifically, I hear a lot of talk about P3s being applied to simple office buildings, and it's really not the right way to go. I mean, you're paying a little bit of a premium in some cases for P3s, but for hospitals, for courthouses, that managing that level of complexity really provides value. I mean, an acute care facility, for instance, and potentially one of the ones that we have together, Claudio, I mean, there's deductions if the humidity level is off in the operating theater. That's real value. That's real attention to detail. And that can have a benefit to, saving lives and making surgeries run smoother. So with that, I mean, what about in healthcare in particular, what are some of the main challenges you see from a contractual standpoint? Maybe I'll go back to Darren, on the development and construction side. I mean, the risk transfer, it's not necessarily a zero-sum game for both parties. It's a bit of a balancing act and a negotiation. How does Gilbane balance taking those risks and still providing a competitive price like you're able to do?
Sure. Thanks, Jensen. And I would echo before I answer that question the sentiment of having the financing cost be slightly higher than what each of these respective entities could finance these projects for, but the overall costs, whether that includes or excludes the maintenance piece, being demonstrably lower. And the reason why that is because, as Jensen said, there is a bit of capital at risk in the event that those standards are not met. And this is also something from a reputational standpoint that if we are not performing well, it would not just hurt us, but it would hurt our enterprises globally. So there's literally a third-party incentive or an external incentive to ensure these projects go well. Now, to get to your question around risk and how we manage it, both from a financing and developer perspective and from a design builder perspective, it really goes into the process in which our potential partners, in this instance, a healthcare system, are looking for, and what type of procurement, how clear of a vision they have, how clear of a process, and how clear the standards are, frankly, that they would want us to live up to. That's absolutely critical in going into any process when you're trying to build a capital asset. But I think it's even more critical if you're looking to go down a performance-based infrastructure route. So as we look at these processes, figuring out whether we want to bid on them or not, and as we continually analyze the process as we go through it, to the extent that our partners, if you will, the ultimate end users of these assets, have a clear vision, have a clear strategy, and know what they want, it's incredibly helpful for us to manage those risks. And then technically, working with firms like Rosemary's and firms like Claudio's, depending on the ultimate structure of the model, we really try to deliver and ensure that what we're building and what we're financing is something that can meet the needs, again, of our potential partners, but can be operated to the highest degree by folks like Claudio and his company, and ensure that from a surety perspective and a cost of capital perspective, which is what essentially a surety feeds into, that we don't have claims, and therefore we have performed under our contract. So does that answer your question, Jensen?
Yeah, it does. I mean, it definitely does. I'd like to also explore, and I can ask Claudio and Rosemary maybe why you think about it, but in healthcare construction or development, like, are there risks that frankly, drive you guys nuts? Like, are there certain things that really, that you have a hard time negotiating with the client? And, we have a lot of prospective clients on the line here. Is there anything that you'd like to discuss at this point? Or
I'm gonna let Rosemary answer that first.
Yeah.
Okay.
It's a good move.
And then I will riff off of that, if you don't mind.
No. And getting back to Darren's earlier comments and looking at the role that we play and looking at contract terms and conditions and the risks that the Gilbanes of the world are assuming and the surety is securing. I mean, how we look at that, it really is not that much different. Maybe there are some other issues. I'm not going to say there are not, but for a large extent, it's very similar in this model, this alternative delivery, this financing model, than a more very traditional construction projects. And terms and conditions are critical. We work very closely with our contractor accounts like Gilbane, and others to go over those terms and conditions. Certainly, there's always risk. There always is. Otherwise, you wouldn't need a performance bond. Of course, there's risk, but it's whether or not there's a comfort level that the contractor has understood the risk, recognizes it, and knows how to manage for it. And making sure there is that expertise to deliver that end product that the ultimate customer needs. What's their track record? Is this a new territory? But one of the things that the challenges that we have seen recently, we can't deny it, is some of the concerns that have been raised in the market is sometimes these projects is the complexity, the size, and the term. And those do raise risks that cause Gilbanes and the CNA sureties of the world to have lots of discussion and how comfortable we are with those and can we move forward? Because we're really making a bet on Darren. That's what we're doing, because as people know, what we're doing is securing all those performance obligations. We're not taking bits and pieces and cherry picking. If the Gilbanes of the world are not able to perform and fulfill those terms and conditions that have been negotiated, it is expected that the surety will step and is obligated to step in their shoes. So I think a lot of that is the same no matter what. Now, I know the trick question is, are hospitals different than other types of projects? They all have their, complexities, and I guess part of it is looking at any real performance triggers, efficiencies. We always look at those, be it at hospitals or others, that we all have. That this, as you pointed out, the operating room and the temperature and this and that. How comfortable are we? Are we comfortable really securing those performance levels after the project's been delivered? And therefore we look to the Gilbanes and the Johnson Controls on, to what extent are we comfortable, and for how long a period of time is the surety going to secure and guarantee those performance levels?
Hey, Jensen, let me sneak a thought in here. Well, first of all, Rosemary, your comment about we rely on the Gilbanes or the general contractors of the world. So put yourself in my shoes. After they build something, we have to take the responsibility for making that work for the next 30 years, right? So we have to rely on the fact that we've got good partners and we've been involved with them on making sure there's a solid design and good execution of that, because as part of this consortium-based effort, we're going to deliver on and operate that for the next 30 plus years. It could even be longer. But Jensen, to your point, some of the things that we think about on risk transfer, and this is where I'll bring, hospital customers into the mix, is during that 30-year operation, you talked about our risk for performance deductions, right? If we don't do what we say we're going to do in the contract, or if space isn't available to the client, we have our services payment deducted on a monthly basis. And it could be deducted for continuous months if we don't, rectify those situations. What keeps us up at night is if we get the balance wrong, right? You want there to be performance deductions that encourage the right behavior from an FM or entity like Johnson Controls, so that we take that shortfall seriously and we take action on it right away, so that we can keep the uptime assurance as high as possible. But if the penalties are too high, that could really mean a problem, right? If the penalties are very punitive, I may end up putting some money into my bid, which may detract from the value for money because you've just got the balance wrong. Now, on the converse side, if the penalties are so low, where it's like, it's $10 a month for, an OR being down, it's like, who cares? $10 a month, that's nothing. So you've got to get the balance right on that risk scenario, so that it's not too punitive where I'm going to price risk dollars in, but it's punitive enough where I'm going to take action and not let things slide for days or weeks. I'm going to take action right away. So that's how I would make sure that there's a good balance scenario in those contracts.
Yeah, that's right. Sorry, Darren.
I would agree, Jensen, and to answer your question a little more directly, there are certain aspects of scope, particularly on the technology side, where some healthcare clients ask us to essentially deliver a turnkey solution where they could literally walk into the building and start operating it, from x-ray machines to building systems and so forth. And as you skew more toward incorporating certain medical technologies, that's where we start to get a little more focused on whether we're best to provide that or whether our partners are best to provide that. And that type of analysis goes on at varying levels when you're talking about finishes and so forth. As Claudio mentioned, his group is going to have to operate this building for 30 years. And what we don't want as a builder is not just our partners or the end users to look at a facility and say it wasn't built correctly. We don't want the customers of our partners and Claudio's colleagues that are operating these buildings to say that either.
Absolutely. I'm just getting some Q&A from the audience here. I have one question, maybe for Rosemary or for Darren. Talk a bit about the differences. If we're talking about the U.S. healthcare market, which is more privatized in Canada, what are the key differences from looking at a opportunity where you've got a province or a state as a contracting entity versus basically a corporation for your payment stream, if any?
Rosemary, do you want to field that?
Yeah, I'm going to try this one. Okay. From our perspective, when we are dealing with, I'm contracting, we're supporting Darren. One of the key things for us is we are only securing the work obligation that Gilbane has. That is it. Also, we don't want Gilbane to have a payment risk, because whoever's financing that project, they've run into issues. It has nothing to do with Gilbane's performance. That's a risk that we assume, that if there's a problem with Gilbane's performance. But when you've got a public entity, there's usually a confidence level. The payment stream is coming in. That's something we're very comfortable with, we're very accustomed to. But when you're dealing with private sources of financing, and if something happens along the way, and we all know it can and has, we don't want Gilbane to have a contractual obligation to continue to perform and to basically be taking that financing risk. Because if Gilbane doesn't perform, the surety steps in and we perform. But we expect to be paid. We're not looking to finance our performance. We expect whoever was obligated to finance that project whoever may be the ultimate owner or concessionaire, that they will pay us. So that's one of the critical things that we will look for when we're underwriting as a surety these types of models, because we know that the public entity is not going to be paying us directly and they will not be paying Gilbane directly.
Yeah, and Jensen, to further discuss what that difference is, and Rosemary touched on this, it's really a function of the financial capacity for our partners, particularly on the developer and investor side, to pay what they're obligated to pay over time. And if you have a public entity, they're kind of known for paying all of their bills. As you look at private entities, or more private entities, if you will, particularly here in the U.S. So think VA, Veterans Administration assets, which is very akin to the type of structure that exists up in Canada's healthcare system, kind of separate non-for-profits or for-profit entities. What has to go on is really two things: a look at their financials, a look at their credit quality and history, and also how critical is this asset to their operations. Is it something that if the asset were not in operations, they would be materially hurt by, or is it something that they could continue to operate with if it weren't operational? And obviously, the more critical an asset becomes to an entity's operations, the more likely that the payments that are due are going to be made.
And then taking that one step further, so either of you could jump in. Like, are there certain either thresholds for this is just my own inquisition, but certain thresholds for either a credit rating or would a corporate entity have to have certain terms and conditions, like termination for convenience repayment, for instance, to know that if Gilbane is terminated, that they're going to be basically made whole, or if equity is left out, their principal would be repaid. I'm assuming those sorts of things, you would be heavily scrutinized by the surety and developer community.
Correct. All of those provisions would have to be looked at. Look, we're entering into a long-term contract where there is a boatload of upfront risk, and there's a boatload of risk over time as a firm like Johnson Controls manages these properties. So to the extent that those contracts perhaps would terminate, we would have to be compensated for the risks that we've incurred to date and the projected returns that we're foregoing as a result of the contract termination. And these are conventionally debt-heavy transactions. So a lot of what I'm describing is going to be driven by our lenders and those markets. That's also the most efficient cost of capital. So we'll be giving a lot of scrutiny to these types of terms, Jensen, as would Rosemary, and frankly, as would Claudio and his team as well.
Great. I've got one from the audience here, David Canary, so pronounce that properly, is asking, what are the advantages to bundling P3 projects? And I know Claudio's got this one memorized, so I'll ask him first.
What was the question? I missed it, Jensen. You cut out.
It's okay. The advantages of bundling.
You want to, bundling, in my mind, is taking a bunch of smaller projects and putting them together under a larger project, which has the advantage of getting the economies of scale. First of all, from a construction standpoint, but then from my perspective, from an operational standpoint, if you think about it, if I'm working with a hospital system that wants us to, do one thing, number of different sites that it operates, there's economies of scale of bundling several projects together, because now I don't have to just, rely on staffing at one particular site. I can think about it as maybe a 3 or 4 site complex where I can have staff shared amongst those and then offer those services much more economically than I would if it was just a smaller project where we might have, very limited resources on one particular site. So that's what I think about bundling. I think about sharing the risk across multiple sites and providing more value and economies for the client ultimately.
I would agree with that, Jensen, and I'd further add that the more bundling that goes on, the more sophisticated both the financial community and the development community players will come and look at that project. There is an inherent amount of risk with bundling, but there's also an inherent amount of benefit. And oftentimes, from our side, there are a bunch of opportunity costs that we incur, and frankly, third-party costs that we incur when we choose to pursue some of these performance-based contracts. So as a result of that, if there's, let's say, a $10 million standalone project, or there's 5 $10 million standalone projects that are grouped to be a $50 million project, the $50 million project would oftentimes attract more players than perhaps the standalone $10 million project.
Absolutely, and as a developer in your space, Darren, we believe in bundling. I mean, there's a lot of cost saving synergies from the procuring entities side. I mean, it's very expensive to hire counsel, technical advice. Things of that nature. I mean, it's millions. It's expensive to give out stipends, which remunerate us for our intellectual property while we're bidding. And then from the bidder side, I have a bit of a minimum equity amount that I need to deploy as well before making basically the 2 or 3 year commitment to bid a project. So I think bundling, like to your point, Darren, really attracts the best who may otherwise pass on a smaller project, and it's also efficient. You get more done. Next question here. Yeah, go on.
I'd also add, Jensen, that probably the most germane reason for some of our listeners to bundle a project is that it brings consistency across the portfolio. Right. Ultimately, there are end users and there are stakeholders that are going to be using these facilities. And I have found it, at least particularly in the healthcare space, that consistency enhances and helps a health system's brand and oftentimes acts as a specific differentiator in attracting either doctors or patients, as the case may be.
That's awesome. Okay, so we've got about 7 minutes. I got one more question here I'd like to ask, and then we can get into some closing remarks. And I've been waiting all week to ask you, Rosemary, this question. But just a hot topic in PPP is always minimizing the letter of credit size, typically from the builder. And even sometimes from the operator, but mostly from the builder. And I'm just wondering, are there any ways that you see around this LC? Are there any other products out there that maybe can help minimize this LC obligation within the overall security package? And you're on mute, by the way.
Okay, all righty. Yes, there are. Yes, there are, Jensen. And I think the surety industry has tried its best to really respond to that concern, because we have seen that, and our customers, our contractors have asked us, because the size of those letters of credit, they're in addition to maybe being challenging, it eats up their other bank lines, and we understand that because we want those bank lines of theirs to be open. So we've seen many sureties. Depending on the comfort level, once again, it really comes down to who the contractor is, who's financing the project, what's the nature of the project, all those confidence levels. It is not uncommon for a surety, in combination with that more classic performance surety bond that really is the performance of the work, to also provide a liquidity bond that does provide, maybe it's not going to be the size of the entire contract. It will be a percentage that can should be able to dramatically reduce the size of a letter of credit that could otherwise be required, whereby it is much easier for the financiers or the others to be able to call upon that bond. It's much smaller, it's much more immediate, so that, because we understand that along the way, if there's a delay, not that you want to ask the contractor to leave, however, there are financing costs when you have delays, and your whole model is you need to cover that cost, and that's what this product would do. And we have seen that written many times, and it's been part of discussions and negotiations and all sorts of projects here in the United States when we're dealing with this. And that's one of the first questions. Will there be a letter of credit, or are you looking for a surety product that can either replace entirely or perhaps minimize the need to post any type of letter of credit? And they tend to be pay-on-demand obligations.
Yeah, that's very helpful. And I'm sure those are very useful to our audience as well. Okay, so we have a couple of minutes here. Before we leave, I just wanted to go around the horn. We can start with you, Claudio, just for some closing remarks and potentially any thoughts of how we could, further spur a P3 pipeline in U.S. healthcare.
Yeah, absolutely. So, Jensen, you talked about this contract structure being a performance-based infrastructure. I love that term. So I'm asking hospitals, look, when you embark on new buildings or renovation projects, think about the performance outcomes you want to achieve. They could be energy efficiency, sustainability, carbon neutrality, uptime assurance. Think about those performance outcomes, make them the basis for your contract, and challenge the private sector with the delivery model, and having them not only be responsible for the design and build, but for the ongoing success of those outcomes for 30-year contracts. You'd be really surprised at the results that you're going to get.
Darren?
I would agree with that. Look, there are many paths to go about building a new facility or renovating your existing facilities. When you're considering those paths, I would absolutely advise that a performance-based infrastructure model be looked at, and that each of you look at your entities and figure out what would be the best path to success. Having those preferred outcomes, whether it's brand consistency across multiple facilities, whether it's having the most technologically advanced facility, whether it's being carbon neutral or green, each of those should be closely looked at and analyzed. And then the path to achieve those, both a conventional delivery model, a design build, and a performance-based model should be looked at. Thanks, Jensen.
Rosemary.
Okay, sure. And the other thing I would add is, when you're looking at these different delivery systems and what may work best for your particular project, no matter what it is, you should always be looking at what type of security, because these are performance driven. So what type of security can we be provided that will secure that performance? Because you're not going to have an end product. There will be no delivery unless the work is completed. There can be no Claudio until the work is completed by the Gilbanes of the world. And that is the most critical, and that is where a surety, unlike a letter of credit or other vehicles, we actually guarantee the performance of that project and make sure that it comes to completion. And we're the only product, and we're in the United States, we're obviously is one of the only countries that really has been very forthright in adopting the full idea of 100% performance and secure, that the surety stands behind it, and that's important for you. And then all the other elements will fall into place. Thank you.
Excellent. So we made it quite the strong case, and I think I hope everyone has enjoyed our presentation. Again, we're all active members of the Association for the Improvement of American Infrastructure, or AIAI for short. You can find us at aiai-infra.org. And if you have any questions, please follow up there. We have a great staff that will direct you to the right expert to answer your questions. So please stay safe, and until next time, we'll see you later. Thank you.
Thank you.